Hello friends, hope you're doing great. Welcome to our channel. Today we'll discuss what is option premium. Quick disclaimer, this video is for education purpose, no investment recommendation, and this is your money, so be careful. Now, option premium, even before we go to option premium, let's take a simple analogy, right? A potato chips wafer, the packet. When you buy a potato chips packet, what you get is chips and the air, and you pay for both. Similar way, option premium is a price which we pay, but it has two components in it. Intrinsic value, it's like chips, and the extrinsic value, which we don't see, but that is the value which is value for or cost for time and the volatility. So in simple terms, option premium is the current market price of an option contract. It is the amount the buyer has to pay to gain that right, because every time we say in option buyer has the right, no obligation, but that right has a cost to it, that is called option premium. Buyer is actually doing a long, maybe a long call option or long put option of an underlying asset. I will walk you through with a clear example, at least two examples, so you will get an idea. But to start with, understand it that buyer has to pay some cost because the seller or option writer is actually taking a risk. So he receives the money. That is an income for him. Okay. Now I go ahead and let's divide the components in option premium. First component is intrinsic value, that is the difference between underlying asset current price, that is spot price, and option strike price. Maybe it looked difficult for now, but just to remember, only the in the money options have the intrinsic value. All other, like out of the money, ATM, that is at the money, do not have intrinsic value. ATM and OTM only have time value and implied volatility. Okay, so intrinsic value is only when you buy option which is in the money. Okay, but let's go with a funny way to remember it. So if you are buying an option which is in the money, that means you getting a wafers chips packet with having little chips in it but little air. But when you go for ATM option, there is no chips in it, only the little air. So that means whatever amount you paying for option premium, that belongs to the time and the volatility or the risk it carries for the option seller. Okay, so you do not have any intrinsic value in it. And for OTM, same way, no intrinsic value. Let's take an example. I focus on the right side. For example, if a call option has a strike price of 100, that means you saying that I will buy at 100 rupees. The stock is trading at a spot or cash as 110. So the current market price is 110 rupees, but you are saying no, 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 I will buy at 100 rupees. That means you are already buying it a cheaper from the market rate. Okay, so there is an intrinsic value to it, that is 10 rupees, and the time value, because it might expire in a week or in a month, so time value is 5 rupees. So total option premium cost becomes 15 rupees. Okay, so always remember that premium has two components in it, intrinsic value and extrinsic value. Now, what are the factors that influence the option premium? One is underlying asset. If the underlying asset is a costly asset like Nifty 50, then premium would be different. But if it's Bank Nifty, the premium would be higher because the underlying asset itself is costly. Then the strike price. Are you buying in the money option or are you buying out of the money option? As we mentioned, there is no intrinsic value in OTM options. They are cheaper to buy. Then the time expiration. Please remember, higher the time or more the time you look for, higher the premium you have to pay. Now, if there is a market volatility, higher market volatility, then the premium cost will also be higher. Interest rate and dividend also have a minor impact on the price of the premium. Let me quickly go back and just mention two important points. Please remember, if you buy option premium, if you buy an option for a longer duration, let's say 1 year option, then you have to pay a higher premium value. But if you buy an option which is expiring tomorrow, definitely it is having a lesser time value and it would be available at a cheaper price. Okay, now quickly let me walk you through an example also which will help you to understand. So I open an option chain, open that on nscindia.com option chain. First of all, I have selected the NSE, I have selected the option contract. I am working on Nifty, but NSE has provided Nifty Next 50, Fin Nifty, Bank Nifty, and Mid Cap Nifty. So let's focus on Nifty. So our underlying asset is Nifty. Today's price on 23rd October was closing price was 25,891. So please remember this price, that is the spot price for my underlying asset. Okay. Now I say that I want to see the expiry for October 28th, which is the nearest one, and that is my monthly expiry. And I also say that I can select the strike price, but let me not select that. And then if I go here, you can see because I selected, so these are all strike prices. Can you see? These are strike prices. Few are above, few are below. And now I go to the 25,891, that is 25,900. So this is my strike price. Spot was 25,891. That was the price of cash market. Now this is a strike, 25,900. If I make a contract of 25,900, that is at the money or near the money. If I make a contract of 25,900 for call or put, that is at the money or near the money, because it is at par with the spot price. But if I buy cheaper strike, that is I say that I want to buy 25,800 call, that is cheaper. So call means your action is first you buy then you sell. Okay, so that means you are in the money. So you see here, when once the moment you do that, your cost will be increased. So now if you buy call of ATM, it is 142.90. But if you buy call of 25,800, that is 210 rupees. So what I'm trying to say, the moment you start going to in the money, that means you have that chips value, right? Or you have the value of the intrinsic value is there. And how much is intrinsic value? It's 90 rupees for now if you compare from spot, because spot price is 25,891 and you buying it at 25,800, because you are buying it 90 rupees cheaper, that is in the money. For in case of call, please remember it's in case of call. Okay, so then your even the premium value will be 210. And then there are other factors like OI change that we will discuss later in our other lecture. But now one more point. So if you buy a put of 25,800, that is out of the money, because here what you saying, the current price is 25,891. I want to sell you Nifty for 25,800. Why would you sell cheaper? Because you buying out of the money. So when you make a transaction or a contract of cheaper value, in case of call starts with C, cheaper starts with C, that's basically in the money. But when you make it for put, that is your out of the money. Okay, I have made one more video on in the money, out of the money, that you go and refer, that will definitely help you. Okay, with that, going back to the presentation. Yeah, so same way we have weekly expiries. Weekly expiries for Nifty 50 happens every Tuesday, and monthly expiry happens every Thursday. Yeah, thanks for joining, and please do like, subscribe our channel, and do write the comment. Thank you.